We had a slightly better week in the S&P 500 with a lot more stocks that are starting to rebound from the poor performances we have seen over the last few months. And our focus today is on Altria Group, the high yield dividend paying company, which was down in fact more than 2% over the last few days. But year to date, where we see a lot of red, especially for the Mag 7, in fact double digits, Altria Group not only paying a very high yield, but is also up 10% on the year so far. So today we want to understand a company that is paying a yield of just over 7%, one that is up 28% over the last year and has outperformed the S&P for quite a number of years, as we will show, is now a great opportunity to consider in the portfolio for the longer term. Now year to date it's also up, as we highlighted, 10%. Over the last 5 years up 84%, outperforming the S&P, but over the last 10 years slightly underperforming the S&P whilst up 14%. This doesn't include the ramifications of reinvesting the dividend, which does have a massive effect, as we will come on to show you. Now it's trading towards its 52-week highs of $60 with one buy rating from Seeking Alpha, but both Wall Street and Quant aren't far off a buy rating themselves, near the 3.5 mark. Now we like to kick things off showing you the institutions hold around 57%. They sold around $2.5 billion over the last year, but in fact they bought a lot more at $3.62 billion, whilst also buying nearly twice as much in the latest quarter. So institutions very clearly bullish on Altria Group. However, we do have to point out that right now the forward valuation around 10.8 is above their own 5-year of 9.3, so this is one possible indication of overvaluation. Likewise, dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year. Right now, even though it's very high at 7.08, it is above the 5-year of 8.15, a double possible overvaluation signal. Then we want to move on to another valuation method, although bear in mind we're not looking at any of these in isolation. We will run it through our own process shortly, but the blue tunnel here dictating the fair price is telling us right now the company sits above even the upper end, so actually 3 possible overvaluation signals. And nice to note, the blue tunnel has been increasing slightly over time, which is what we always want to see from companies we're invested in, ideally for them to be worth more and more as time does progress. However, having said all of that, on the valuation grade they do get an A, reason being the sector trades a lot higher at 16.1, meaning right now the company is at a 33% discount, but as we did just highlight, it does sit around 13% above their own 5-year, and for pretty much the majority of valuation metrics, they do look to be trading at a discount to the sector, whilst also at a very marginal increase to their own 5-year numbers. Now they reported their latest earning Q4 of 2024 not too long ago, and actually the share prices were down. Main reason for this, and one thing we need to consider when thinking about the tobacco industry, is a decline in volumes, and specifically in relation to cigarettes. Now we'll talk about how they performed as well as the expectation moving forward, covering their latest investor presentation. And what we want to highlight right now is that their EPS came in at 129 and their revenue was around 5.1 billion, and pretty much in line with what the analysts were expecting. And again, this held true for their full year earnings. So analysts aren't really surprised about where this company has been in terms of their numbers, but one thing they do want to see is a bit of an increase in the volume, something that we haven't seen. And one of the major factors that management have put this down to is there's been a lot of growth in illicit, illegal e-vapor products, and therefore their own consumers have been moving away from their own products and buying cheaper ones by whatever means necessary. Now 2025 they're expecting 522 to 537, and this represents growth of around 2 to 5%. We're going to talk a little bit about what to expect when investing in this company, but something that's really great to see is that the company approved a $1 billion share repurchase program, and this is one way, on top of paying a very high yield, that the company management are able to return excess cash to your pocket. Now speaking of earnings, the next 4 quarters they are expecting growth for every single one around the mid-single digit, whilst also having a historical 75% track record, 3 out of 4 beats, and based on the EPS for the full year, they're trading at a forward valuation around 10.8. Now a few things that we need to consider, and most importantly, are that overall globally we are expecting expecting to see a decline in the number of smokers. As we can in fact see here, the yellow bar highlighted for 2030, there is expected to be a drop in pretty much every single company other than Indonesia, which is anticipated to have quite a substantial increase. And again, we can see this from another data set where the number of tobacco smokers among those above the age of 15 worldwide is anticipated to drop by 2030 and quite significantly. And this is something that, if the trend continues, is something that every investor for Altria Group does need to consider, and that is why we will run our own valuation and use a margin of safety. It's also something that management appreciate, not something they hide from. In fact, they do talk in their investor presentation pretty much every quarter and on an annual basis that cigarettes are declining. In fact, for the full year of 2024, they did see around 11% drop in the volume, and the industry sitting around a 9% drop. So what they're highlighting here, we're getting a massive drop by people who are smoking, but actually they're seeing a little bit more in terms of the volume from their own products than what they have noticed across the industry. Definitely, again, lots of things you need to consider. Yes, it's great, they do pay a high dividend, but you also need to consider the future prospects. And one area where they see a lot of growth is the smoke-free category. We're talking oral tobacco, we're talking e-vapor, and we can in fact see from 2019 to 2024, there's been a 2% growth year on year, while seeing a decrease to cigarettes. But again, the growth isn't going to be very substantial. We're talking about people who are smokers who are either quitting or moving away to these smoke-free products, and that will ultimately have an effect on their top line revenue. Having said all of that, management are still very good at what they do. We notice an earnings per share growth into the full year 2024 at plus 3.4%. And as we said, they return a lot of cash to investor pockets, 2024 at 10.2 billion. And remember, they have approved a 1 billion share purchase program, with one of the things they're focusing on for the full year of 2025 is smoke-free product research development, so that they can maximize growth from other areas where they do believe will hopefully over the long term increase their top line. And they anticipate earnings per share growth of 2 to 5% for the full year of FY25. In terms of the split, share repurchases sat around 34% of where all that money went to, with dividends the large bulk, no surprises given the yield at 6.8 billion, and they still noted a dividend increase of 4.1%, always great to see. That is pretty much in line with inflation. We'll cover those other metrics shortly. Now, speaking of their debt to EBITDA, something that we really like to drill on this channel, it essentially correlates to balance sheet strength and dividend safety. Now, we want to see below 3 for this industry. It's sitting at 2.29 on a trailing 12 month. That is below, so dividend does look to be safe. Balance sheet does also look to be okay, but the nice takeaway here is they're anticipating to pay off a lot of that debt, dropping to around 1.73 over the next 12 months. Always a great sign. We want companies with very strong balance sheets, especially ones in areas that we can see some potential issues moving forwards. And as we highlighted, they do return excess cash to those share buybacks, 1.96 in 2015, now sitting at 1.72, and they are anticipating this to increase given that 1 billion share buyback program. Now, dividend growth is something we like to closely look at on this channel. 4.1% August last year, 4% over the last 5 years, so they have been pretty much increasing the dividend in line with inflation. Over the last 20 years though, when we do stretch it out, not the greatest at 1.8. As we said, a minimum of 4% is ideally what we want to target, but one thing we do have to say is they are a dividend king with 50 plus years of consecutively increasing the dividend. One thing that maybe also goes under the radar for Altria Group is the very high return on invested capital they have. As always, giving us faith, management are able to effectively allocate their capital. Above 15% is what we want. We get that every single year. In fact, climbing from the lows of 2018 to 22%, now sitting at 46%, and that is really strong, not just for the tobacco industry as a whole, but when we look at many companies on this channel, 46% or around that area is very rare to note. But you're probably not surprised given everything we have just gone through that their growth does sit at a D-. Year on year, flat, forward looking, expected to be flat. Now compare that to the sector median at the low single digit of 2 to 3%, and it's not far off their own historicals of 2 to 1%. But remember, the industry isn't one that is increasing, volumes are decreasing, so what they're having to find themselves is to essentially increase the price of their products or look for alternative ways to increase their top line. As we can see, smoke-free products are one area that is actually growing. Now, earnings per share, they're expecting growth of 4.3% over the next 3 to 5 years. Sector median in comparison, 7.4, a lot higher, but their own 5-year at 4.73 isn't that far off their own expectations. And we can highlight here over the last 10 years where revenue has been going in terms of positive or negative. The last 3 years, actually a decrease, trailing 12 month again showing 0%. So actually what we really want to drill home here is their top line isn't even increasing in line with inflation at around 4%. So real terms, Altria Group is declining. Doesn't mean it's a bad investment, but again, lots of things to understand for your own investment thesis. Having said all of that, earnings per share is increasing over the last 10 years. Free cash flow, something we look at a little bit more closely, given EPS is susceptible to manipulation, has also been increasing, nearly double from 286 in 2015 to 501, but is anticipated to have a slight drop over the next 12 months. But their profitability does come in very strong at an A+. As we said, they need to increase the product prices to really mitigate the risk of the decline in volume. Gross margin 70%, well above the sector at 36%, above their own 5-year of 67%. Bottom line, 55%, well above the sector at 4%, well above their own 5-year of 24%. Their margins are not only absolutely incredible, but even higher than their last 5 years, meaning we're noting some very strong efficiencies, whilst their cash generated at around 8.75 billion is slightly higher than the last 5 years at 8.56, but well above the sector at 803 million. And we can see one of the best margins we are noting in the industry, operating well above the minimum 25, but also very strong efficiencies, 46% in 2015, 59% on a trailing 12 month, and the free cash flow margin above 20% consistently, now sitting at 42%. So a lot to love with this company, whilst it does come with its own risks and issues. And what we want to highlight that we would say could come to a lot of investors as a bit of a surprise, year to date, Altria Group has outperformed the S&P up 10%. In fact, S&P down 4%. Over the last 12 months, again, Altria Group has outperformed nearly 40%, with the S&P at the 8% point. The same to be said over the last 3 years, 41 above 27, and again over the last 5 years, 176%, S&P 153. But if you were to look at the last 10 years, we can see Altria Group has underperformed, 115%, S&P 175. And if we were to go back to 1995, so we're talking 30 years ago, Altria Group has massively outperformed the S&P, 4,922%, S&P itself 1,036. One other external factor we need to consider about the markets is that we are in quite a bearish territory. There is extreme fear currently in the market, short term, medium term, with tariffs and many other tensions right across the board. So that is also having effect on all of the companies. And even after the drops, we are still seeing a lot of them in fact sitting at some very high valuations. But if we look at Altria Group, it is sitting in the green at a forward basis around 10 to 11. Now, whilst you can't solely look at that and say that it is a buy, it does make it fairly attractive when we looked at it in comparison to the sector as a whole. Philip Morris, which is also a strong company in the tobacco industry, trades at nearly twice that at 19.5. Again, these are things that you do need to collate in your investment thesis and understand whether the company is right for you. Just before we jump into our valuation, then we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of March. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. So our intrinsic price today comes to $58, which is the average of these three models. Now we'll quickly show you the inputs and the outputs. First model, Graham's valuation. We have the stock ticker symbol, the earnings per share, long-term growth rate, the AAA corporate bond yield, giving us an intrinsic price of $54, which is above the market value, so our first overvaluation signal. Now we haven't used the multiples valuation, but we will just tell you why and the number it comes to. As we've already highlighted, many companies in the industry are trading severely above. We have Philip Morris sitting around 20, we have Universal around 11, BTI around 9, on average sitting around 14, which would give this an intrinsic price of $75. Now we would get the undervaluation signal, but what we're doing here is showing you the number if you do believe actually you should use it. that it highlights that Altria Group is one of those companies right now trading at the lowest valuation in the sector, something we did also highlight earlier. We then move on to the dividend discount model, the average growth at around 4%. In fact, the last few years it has sat around the 4 to mid 4 point. Moving forwards, we've gone very conservative at 1.5, where we do get our first undervaluation signal at $64. Then we move to the DCF model, free cash flow year on year, including the full year of FY24. Average growth just over 8%. Now we have to bear in mind declining rates in cigarette sales, and therefore we view negative 2%. Again, you could argue that's very conservative. With the discount rate, we then get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to $56. Not far off, so we have an overvalued signal here, but you could also argue, based on DCF, reasonable signal. Now the intrinsic value, as highlighted, the average of these three models, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Altria or any others, but we're not done there because we always like to add a margin of safety, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now this highlights is a buy at around $52 if you believe 10% is appropriate, but really what we're getting at right now, given the intrinsic price sits near the current value, we're saying Altria Group, based on what we've just run through, is looking at a fair value territory. Now Wall Street themselves actually see this at downside over the next year. They see this at $56.30, negative 2%, but you could argue many different reasons why this would be in your portfolio if you're someone that actually uses the income from the dividend that's paid out every quarter for your own expenses. Maybe you believe over the shorter term it has outperformed the S&P and you believe this will continue. Lots of different considerations, and for those that do want a margin of safety, at 10%, a buy at $52, at 15 around $49, at 20 around $46, and at 25% around $43. As always, give us your thoughts. Do you believe Altria Group is a buy, hold, or sell? And don't forget to sign up to the free weekly newsletter. Grab those spreadsheets. Come and join us in the Patreon where we do cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.